Hey guys, and welcome back to Smart Money Minds. In today's episode, I'm going to be going over 4 key strategies that I use every day in my stock trading. And so far, they've helped me turn numerous losers into winners. Buying and selling stocks really isn't that hard. You literally just click some buttons and poof, you either earn some money or you lose some money. However, have you ever had plays where you had winners, but then they turned out to be losers? Or have you ever had a stock that goes flying, but yet you just sold too soon? I'm going to tell you what I've learned so far, and so hopefully it'll help you manage your positions a little bit better. My first strategy is scaling in and scaling out of stock positions. The stock market is unpredictable in really all sense and form, and it's laughable to think that we really have any sense of control about how the market will react. And it's made up of millions of people and billions of dollars constantly buying and selling, and it's really like a global flea market. I'd like to think that it's almost impossible to hit the lowest of prices and to sell at the highest of prices. But if we can just get the meat in the middle, then we're winning. So scaling into a position means that if you're entering a position, scaling in means buying small positions over time. So for example, let's say I'm looking for an oversold bounce on this chart. An oversold bounce means that a stock is selling very aggressively, and so at one point it'll run out of sellers and only the dip buyers will be left, causing the price to spike up. The strategy of scaling in is to buy a little at a price where you think that it's going to bounce. And if it goes any lower, you buy a little more and a little more. And this will allow you to average down your price for your position. So let's look at an example here of WEED, that's the ticker, on July the 29th of 2019. So this is what I mean by an oversold bounce. It runs out of sellers and it changes the trend and it bounces a couple of percent. So when we're scaling in, what I'm talking about is, for example, I will buy a position at, let's say, at $44 right here. Okay? And I will buy a second position at, let's say, at $44.40 right here. So at this point, if I'm buying 2 positions, 44 plus 43.40, not 44, if I divide it by 2, my average price for this position is $43.70. So now, as you see that it actually bounces past this point, and when it passes this point here, then maybe I can take some profits at $44 because my average is only at $43.70. And I'm gonna take a little more profits up at $44.40 as well. So now you see that I can continue to scale in when the price is dropping and when the price is raising and rising up again, and I can scale out of my profits. This is helpful because let's say I enter all my position at $44 right here, and I have no more cash to enter as it keeps going lower, so I can't average down my position. And it takes a while before it actually goes back up and breaks $44. You gotta really hope that the bounce takes place and you can take profit above $44. But sometimes the bounce doesn't go past that point and you'll be in a loss instead of in a profit if you were scaling in. This will allow you to feel like it's not all or nothing, and it gives you more wiggle room for your trade to develop, and also allows you for less fear if you, say, enter too early, and less fear of missing out if the price starts taking off or you sold too soon. Which leads me to my second strategy, and that is to set your stop loss at a break-even price after you take some profits on your trade. Let's say you made a winning trade and you're up some money. At this point, how do you make your trade risk-free, where there's zero chance to lose money? Easy. Once you see that the stock continues upwards, then you can set your stop loss at your purchase price. If you bought your shares in, say, at $14, and now the price is at $14.50, then you can set your stop loss at something like $14.02. That way you can take a tiny win and also cover your trading fees if it drops down to that price. Literally, you can't lose at that point unless the stock halts and everybody loses their money. What you can do as well is also take some profits on the trade. For example, if you bought 1,000 shares at $14, you can sell 500 of those at $14.50. The profits from selling will make your average stock price drop to $13.75, meaning that you'll break even in your entire trade if you sell the rest of your 500 shares at $13.75. So if you set your stop loss there, once again, you can't lose. My third strategy is to always have a game plan and to follow through on that game plan. The stock market doesn't stop, nor does it end. Some people never put their money into the market and they don't participate at all. But however, if you do put your money in, then you can choose your start time and your end time. You can buy and sell within 30 seconds and make a small profit, or you can buy and hold something for 40 years and never touch it and then sell it then. Having a game plan means that you know when you're going to buy and when you're going to sell. And that's either for a targeted price profit or a acceptable loss that you've already calculated in. Let's look at the chart here, S&P 500 from 2002 to 2009. Let's say I bought some S&P 500 at $80 in 2003. I see that it keeps going and gaining as it breaks the $100 mark. Now what I can do is set the stop loss at $100. At 2007, it hit $150. So now I can move my stop loss to $140. But you see here in the 2008 market crash, I would have stopped out at $140. And I wouldn't have to end up holding all my shares till it hit $67 at its lowest point. And yes, eventually the S&P 500 did recover, and then you see it continue to rise. But for an entire year, your money wasn't working for you. So why not have taken your profits at $140 and rebought those shares at a lower price? Maybe your game plan was only to buy in at $80 and take profit at $100, and you can be happy with that $20 gain. My point is, once you set a game plan, you can follow through with that playbook and make consistent gains. You can cut your losses when your money just isn't working for you, and you can always take your winning trades and be happy with that and not feel like you're missing out when it keeps riding higher and higher. Our fourth strategy today is to manage your emotions, knowing when to let plays go, accepting losses, and overcoming FOMO. If you're emotional, you'll make knee-jerk reactions, and this happens in relationships when you say something you can't take back, or at work where you make a really silly mistake, and this is especially true when it comes down to your money. We are often more afraid of losing money than getting the opportunity to win. And this is a psychological theory called loss aversion, and it's better to not lose $5 than to find $5. So when we're down in our trade, we are often hoping for it to turn around. But when we're up in our trade, we're also scared that we're going to lose what we are already up by. We are also subject to market psychology. So when the market is up, then everyone is making money and no one is selling, and it's euphoria. Everybody's making money. But when the market is down and everybody is in fear and selling everything they got, then it gets to a point of maximum fear. By understanding how we feel and how the market feels, then we can position ourselves better. We can always buy at max fear, and we gotta be cautious when it's euphoria mode. We also take losses, but have you accepted those losses in the first place? Or does losing make you feel like your day is ruined? And in the comments below, tell me what kind of strategies that you followed or you've heard of for stock market trading. I've always liked to hear from you guys to increase my own playbook with more tips and tricks. And make sure if you enjoy this video to hit that like button, subscribe to my channel, and then we'll see you guys in the next video.